Is long-term care tax deductible for individuals? And what about those business owners out there?
Yeah. This is a great thing. This is not a reason to buy long-term care insurance, but it's a nice bonus. So I want to put a disclaimer out there. It's always best to consult a tax professional, talk to your CPA, but here are some general guidelines. If you are an individual, it's going to depend on if you itemize your deductions. If you don't itemize your deductions, there is no deduction for your traditional long-term care insurance, okay? If you do itemize your deductions, this is going to be treated as accident and health insurance. So it's going to be limited to the lesser of either the actual premium that you paid for your long-term care insurance or what they call the eligible long-term care insurance premium, okay? And what those eligible deductible premium limit amounts are, they're based on age limits, Nick. So in 2023, these eligible long-term care insurance premium limits are for 40 or under, the limit is $480 per year. If you're 41 to 50, it's $890 per year. If you're 51 to 60, it's $1,790 per year. If you're 61 to 70, it's $4,770. And then if you're 71 and older, it's $5,960 for 2023. So you can see that it's more favorable the older you get, and you can deduct to the extent that medical expenses, including long-term care insurance, exceed 7.5% of your adjusted gross income. So this could be tricky to get a deduction if you don't have a large amount of medical expenses, right? Because it has to exceed that 7.5% of AGI. So something to consider. What about business owners? This is going to depend on the structure of your business. Let's talk about the most advantageous way. What type of business gets the most? Well, it's going to be C Corps, including personal service corps. So, and actually LLCs that are taxed as C Corps. They're going to have the greatest advantage and benefit because they can actually deduct 100% of the premium, and they are not limited to any type of age-based limits like I just talked about. So this is huge. So if you are a C Corp, you need to look into long-term care insurance to see if you don't currently already have it, because, you know, it is valuable, not just for the tax benefit, but of course for the protection too. Now, what about other types of businesses? Let's talk about the self-employed. So when we're talking about self-employed, we're talking about those sole proprietors, partners, S Corps, if you're greater than 2% shareholder. And then if you're a member of an LLC or a PC, taxes any of those. So what they do in this case, Nick, is they look at what they call the eligible for self-employed health insurance deduction. This is going to be taken above the line, is what it's called, on line 16 of that IRS Form 1040 Schedule 1. So basically, you can include a spouse or other eligible tax dependents, and you're going to be limited to the lesser of that actual premium that was paid or the eligible long-term care insurance premiums based on that age that we talked about earlier. But here's the key. The deduction is not limited to 7.5% of your AGI threshold, like it is if you're an individual tax holder. So that could really be a great advantage because I think, let's face it, probably not most Americans are going to have medical expenses above 7.5%, right, of AGI.
And it's probably really hard to qualify for long-term care if you have medical expenses already in excess of 7.5% of AGI.
That's right. That's right. So being self-employed, you are not limited to that 7.5% floor above AGI threshold. So that...
But you still have the same eligibility, or you still have that same cap age, that age-based range, right?
That's right. We're still looking at the ages, but you're not limited to that 7.5 of AGI. That's right.